Redfin just released their 2026 forecast, and they call out something that was buried in this report that I believe is one of the most significant things I am personally seeing in real estate. I believe it will change the trajectory of how markets function next year. And it's crazy because it wasn't even in their top 5 points. They probably don't even realize just how significant this might be in 2026. But I am going to show you the shift in data. And before I even start talking about their predictions, anytime someone is predicting, it's more important to understand the why behind what they are saying than what they actually think will happen. Because generally, they're forecasting something that's completely unhelpful, like national home prices. Nobody is buying the national housing market. Now, even in Nashville, telling people home prices are up or down, it's completely unhelpful because we're seeing both happen. So when we talk about Redfin's forecast, pay less attention to where prices are going to be because they've been wrong for the past 3 years on their forecast, and I mean bad wrong, but some of the comments they make were still true. The insights they had were something to pay attention to. So let's go ahead and look at the 11 Redfin predictions, and I'm going to stop on number 8 and 9 and show you the trend that will change everything for 2026. Prediction 1, mortgage rates will dip low 6 range. The truth is that if you shop your rate right now, you should be able to get rates in the high 5s. At least everybody I talk to is able to get rates in the high 5s. And when you shop your rate, ask, what's the origination fee? And you don't want any points. That way you can compare apples to apples. At least that's how I do it. Prediction number 2, home buying affordability will improve as wages grow faster than prices. We've been seeing wages grow faster than prices. So what Redfin is actually predicting here is what has been happening, more of the same. We expect the median U.S. home sales price to rise 1% year over year, and we expect wages to continue to grow faster than that. Prediction number 3, home sales will rise 3%. This again is something we've already started to see change at the end of the second half of last year. We're starting to see the number of transactions, the number of people purchasing actually increase. So it doesn't surprise me if 3% happens. Now, I will say part of the reason I think transactions are going up are especially in areas where prices have come down, more affordability, where prices are holding out, buyers and sellers are still at odds with each other. Prediction number 4, rents will rise as demand for apartments rises and supply falls. Now, this one makes no sense to me because they're also predicting high housing costs will reshape households with more roommates and fewer babies. Now, this makes absolutely no sense, okay? They're saying households will consolidate, but somehow demand will rise in apartments. It takes a lot of mental gymnastics to think that we could have an increase in home sales, an increase in apartment demand, and household consolidation. I'm not saying it can't happen. I mean, you could have immigration, but to me, these predictions are not super helpful and contradictory. But let's keep going. Prediction 6, affordability crisis will unite policymakers across party lines. In Nashville, we're seeing a big push for more supply, and it is the reason rents are down. Home prices and rents drop when there's supply. Where they build, prices drop. That's the beauty of capitalism. You use the incentive for people to build and create and to profit to create so much competition that people have to provide better value at lower prices, and we are seeing it. Prediction number 7, more Americans will refi and remodel, largely because 20% of mortgage homeowners have a rate above 6%. Okay, now, before we get to number 8 and number 9, just want to acknowledge 10 and 11. Prediction 10, NAR will let local MLSs call the shots. Okay, that's interesting if you are majorly in the weeds on how the MLS functions. Prediction number 11, AI will become a real estate matchmaker. Okay, of course it will be. Prediction 8 and prediction 9 go hand in hand. They're extremely, extremely important. Okay, prediction 8, New York City outskirts, Great Lakes region will be hot. Zoom towns like Nashville and Austin will not. Here's where I have a strong opinion. Homes will languish on the markets in coastal Florida, along Texas, due partly to natural disasters and surging insurance costs, and partly to pandemic-era remote workers moving back to where their office is located. People who need to sell may be forced to take a loss. Housing markets most likely to cool in 2026. They put Nashville, Tennessee at the top. Now, what I find funny about this is you have Texas property tax issues and they have climate risk. Florida, much higher climate risk. They have insurance problems. The difference is that Nashville not only does not have the climate issues that both Florida and Texas have, they don't have the property tax issues that Texas has. And when it comes to remote work, I personally believe that Nashville's a net winner. Now, one of the reasons I believe that Nashville is a winner when it comes to return to office really has to do with this report right here by PwC and Urban Land Institute, their markets to watch report. You can see Nashville is still number 6 on here. But the reason that's important is because it actually talks about, even though Texas and Nashville are still great places, the largest downward movement occurs among Tennessee markets, with Memphis down 19 spots and Knoxville down 18 spots. Now, if return to office was impacting Tennessee markets all the same, I believe Nashville would have dropped much further. But you tell me, if you have a perspective on this, I would love to hear what you have to say. The thing about this is, and this is what I want to get to, it's not about remote workers moving away from Nashville, but it's about how people are going to choose to buy in 2026. Because remote work is going away and return to office is happening, we are seeing a shift away from the outer, further areas and back into Nashville. Let me just show you a chart. This is contract volume for the past 12 months, okay? Just the number of contracts. The blue is Davidson County. Again, that's Nashville. The red is the wealthy suburb of Williamson County, Franklin, Brentwood, Nolensville, Fairview, Spring Hill, Thompson Station. Okay. Davidson County has always been, over the past 12 months, lower in contract volume than Williamson County until this last week. It just went above Williamson County. Now, why is this important? Because people that are moving from other areas are buying the 650 to 2 million range. These are your white collar workers. They're moving, remote workers moving back to Nashville. Now, let's take a look at some neighborhood dynamics and look at the demand shift in Nashville. And what do you see? Okay, we see areas that have been soft for a long time. Look at all the red. Look at all the red in Nashville. This has been blue, meaning it's been shifting lower year over year. Now it's shifting stronger year over year. Now, these shifts sometimes can be very small. And this is a perfect example. Edge Hill, this is right next to Music Row and just north of 12 South. Okay, last year it had 26 active listings with 1 under contract. This year it has 22, so it has less active listings and 5 under contract. This is a major shift in demand. We're also seeing it on the west side here near the Nations and TSU. Here we can see 45 active listings, only 3 under contract last year, 52 with 9 under contract. The Nations, we have 12. We have more demand in the Nations. In Charlotte Park, we have double the demand. Okay, we do have more active listings, but we have double the demand. Belmead, one of the most expensive housing markets, it has 2 under contract right now. I mean, the median price is over $2 million. Let's look off of Woodmont. Woodmont, 6 under contract right now. Last year it was 1. There's more active listings, but there's way more under contract right now. There's a lot of more activity happening in a lot of these areas than were happening last year. Sylvan Park has slowed down, and I'm curious why, actually. I would be curious as to why, even Sylvan Heights is getting a little bit more demand and a little tighter supply than Sylvan Park. I'd be curious if someone has a perspective on that. I find that interesting. 12 South, we have the same number under contract, so same amount of demand, but a little more active listings. So it's just moderately softer. The point is, though, here's the point. The areas that have been suffering, like this is in Madison area right here. Here we have 5 under contract. Last year we only had 1. It's just neighborhood by neighborhood. You're seeing more and more neighborhoods have just 1 or 2 or 3 more under contract than they did the year before. They tighten up the market. In general, you're just seeing more demand. Now, when we go to Brentwood area, Brent Haven, 24 active listings. They only had 7 active listings last year, 4 under contract. Now they only have 2 under contract. It's a lot colder in the Brentwood area. Nolensville, let's go back to my daily charts here. If we look at Nolensville, top 15 cities, let's just look at Nolensville for a second. If you are looking for a $1 million house, this is the supply ratio of active over contract, okay, in Nolensville. There are 51 active listings, only one under contract. Look at this. Active listings 51. There's only one under contract. Last year there was 4. The year before there was 11. A quick clarification here. It's only one under contract in the past 31 days, not one under contract. So there's some that have gone under contract and just sit for months or maybe 45, 50 days. We don't count those. This is meant to show an expression of months of supply. So that's why it's a little bit different. If you were to research how many $1 million listings there were in Nolensville, you might see 14 under contract. Well, 13 of those have been sitting under contract for months. Nolensville, to me, looks like it's slowing way down. Why? Well, if it is a return to office, Nolensville is not a fun place to be when you have to commute to Nashville every single day. So there's a lot of places where you have to commute to Nashville every single day that start becoming a lot less attractive. When you are buying or selling or whatever you're doing, you have to put the lens of how does this property relate to where people are going to work. I believe that will be one of the strongest trends in 2026 real estate because I'm already starting to see it in Nashville. It's very important. Now, the other prediction 9, climate migration will go hyperlocal. Places that have high fire risk that people are no longer, companies are no longer providing home insurance for, they become a lot more difficult to live in. You're going to see people shift out of those areas. And the Palisades is a perfect example. I predicted at the beginning of this year that there would be probably 100 or 200 more transactions in Nashville. And we did not get that, but we did get a 20%, a very double-digit growth in the number of 3 million plus transactions. So it is still growing in Nashville. It wasn't quite as high as I thought it maybe would have been, but the point is that Nashville continues to get more and more migration, the jobs that are moving, the people that are moving to Nashville. But this year, 2026, people know they have to go into the office every day. They're thinking about their commute way more today than they were 2 years ago. It's going to shape the housing market. Even if you don't care about that, you should probably consider that as people are looking, it's going to be more competitive in accessible places. And with that, I hope you all have a great rest of the day. I look forward to seeing you next Saturday. Thanks for watching.